It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, smartest guy in the room. You know him, Mr. Michael Becker.
Hey, Paul.
How are you, Michael?
Things are going pretty good. How are you?
I'm doing well. Are you guys closing any transactions over at SPI?
We just closed a couple here recently and got a couple more trying to get put together right now, actually.
Give me an idea on like your last transaction. How big was that?
We did a 2-pack. So we bought about $74 million in real estate, raised about just shy of $25 million. It was about almost an $80 million total capitalization with, closing costs and renovations and stuff like that. Had 2 different properties, 2 different markets, 2 different loans. We got a, Fannie Mae loan on stabilized, brand new Class A deal. And then we had a bank bridge loan on a deal that we're going to put, about 8,000 a unit in CapEx into, push rents, materially, and then, hopefully refinance or sell it a few years down the road.
And why did you want to do, or why did you have to do a bank bridge loan on that one?
I didn't have to, but we could have got a Fannie Mae loan on it. But it didn't fit the setup. I mean, it was a big reposition with big upside on rent. So if we put a Fannie Mae loan on it, we'd kind of have we wanted optionality in a couple years. So we have some extension options built in the loan. So if we need to, we can extend it, but we wanted to be able to either refinance it or sell it because we're going to have a big value creation is what we're projecting.
When you say value creation, is what kind of a bump in rents from where you have it today to where it's going to go?
This deal was ridiculous. So it was in the Keller Independent School District. So this was probably the best school district on the Fort Worth side of town until you get over to maybe South Lake Carroll. But, for this part of the town, this is like a best school district and a real good product built in 2009. And the rents were $1 a square foot. And this should have been about $1.30, $1.35 a square foot. So almost $400 in nominal rents.
How important is schools?
For this particular property with a bunch of 2 and 3 bedroom units in this location, it's everything, right? So, and if you cross the highway, you're in while it's a good school district, it's an inferior school district. So this was the best in class in a big surging area between 2 major employment centers in the Fort Worth side of town. And, had a bunch of big units, a bunch of families living there, and the rents were about $400 low, which is a ridiculous amount of money to leave on the table. And so we figured we get about $200 for asking for it and about $200 for doing the work. So what that means is it's about $200 in loss of lease just by implementing better management, just asking for it. So if I don't spend a single dollar, I think I can raise rents $200 over, a couple year period. And then if we also go in and, swap out the granite and stainless steel appliances and fixtures and floorings and stuff like that, we're able to get another $200, we think, in additional lift. So that's really what we saw there, Paul. And that was, a massive amount of upside. So to do that and put a loan on it that you're stuck in with a big prepayment penalty just didn't make sense because our capital would be stuck in there. Not only the capital that we stuck in the deal, but the capital that we're going to force by creating all this additional upside.
Well, as you can hear from Michael, he's gone from being a big commercial real estate banker to being almost a bigger commercial real estate owner. So from a loaner to an owner, so he has a lot of information that he shares with us. So we very much appreciate that. Question that has come into the podcast today that I thought was a good one is, Michael, can you define what a key principle is? For one, is a key principle the same as a loan guarantor? Do all general partners need to sign the loan guarantor or a bad boy carve out? Thanks. Love the podcast.
Yeah, I'll go back in the day when I was a commercial real estate lender at a large national bank, and Paul and I were just doing, a loan a week together, basically, coming out of the recession. We wouldn't do non-recourse debt. Everything was joint and several guarantees, or maybe we'd have limited guarantees, but it was, to your balance sheet. It wasn't the key principle, the carve-out concept. So what we would do there is we would make you sign it. We would require, it was our bank's policy that we had 51% ownership or more sign the guarantee. So we'd have to have many people sign the guarantee. And if you defaulted, we'd come after one of you or all of you for the deficiency in our loan. That's pretty ominous, and that's would create what we call contingent liability. And then what we borrow now is we won't do deals with carve-outs or sign as a key principle. So what that means is bad boy carve-out is that the loan is non-recourse unless you commit a bad boy act, meaning like I commit fraud or misrepresent something or, gross negligence, something along those lines, and the guarantee could be sprung in at that point. But if you're just a bad operator and, if the example I like to give is my favorite city to pick on is if Dallas turns into Detroit and half the population moves out over a 30-year period and there's no one to lease my buildings, I could toss the keys back and they don't have recourse to my balance sheet. So that's kind of the major difference of the two.
Yeah, that's one of the things that I think people try to sometimes confuse, that the property's not being operated well, That's one thing. If the economics of the market are going to give you 50 or 60% occupancy and you can't pay your bills, that's another thing. But if you have, in the first case, if you don't operate the property well, then there's ways that it may go from a non-recourse loan to a recourse loan, and then you can find yourself personally liable. So those are the bad boy carve-outs, and Michael touched upon a few of them. One is that if you intentionally run the property into the ground and you file for bankruptcy, or the bankruptcy is in the entity, and you don't want to push the property over to Fannie Mae when they go to foreclose upon it, that will violate the bad boy carve-outs. So that, Fannie Mae wants to be in the position to catch the loan, catch the transaction once you say goodbye. They don't want you to have an impending problem to stand in the way.
So let me ask you a question, Paul. Back where 7 to 10 years ago, you and I were doing a bunch of loans together, and I think I was probably doing almost half the loans that you did. We did a whole lot of loans together, then the other half would go Fannie Mae. What's kind of your ratio now between like the agency type lenders, or how many of your loans that you have joint and several guarantees versus the carve outs anymore?
So joint and several, I would say about 20%, 15 and 20% are bank transactions, and probably the rest are Fannie Mae or Freddie Mac.
With recourse, or is banks with non-recourse?
So between the 15 or 20% and that, are probably half and half.
So you might have 10% of your loans now have joint several recourse, and 90% are kind of just with the carve-outs?
That's right. And so we just did a transaction that we got approved on Friday where the borrower needed to cash out, really pay off the lender that he currently had it with, and we came in to refinance that. That was a bank loan, and the bank was going to give the most flexibility for a short prepayment penalty, longer amortization, but they wanted not only to collateralize the building, but they also wanted to have an interest in his personal balance sheet. So he didn't have a problem with that because he was going to pay it anyway. He really didn't care. He was a smaller operator, but this was kind of his only asset. He's a dentist, orthodontist or so, that he didn't really care. But if you start to become a larger operator, you don't want to cloud your balance sheet.
So how does that compare? Like you said, 10% have actual joint and several recourse. What did that compare? You and I did a ton of loans in, say, 2012 together. That's probably our peak year doing loans together. How many of those back, if you had to estimate back in 2012?
I'd say 75%
had
recourse of something. But now those players have gotten larger, and they don't want to cloud their personal financial statement.
And there's just more options today. There wasn't a whole lot of options back in 2012.
Yeah, there was only one option: pay for the property in cash.
Yeah, that's right. So then we were, I think that's kind of important to get a little sense of history. A lot of people haven't been in the business all that long, or certainly weren't doing deals back then. That, markets ebb and flow and they change. Or just because it's like the way it is today, it doesn't mean it's going to be the way it's going to be in the future, because you had a contraction. A lot of these people either tighten up the credit standards, they, want more options on repayment, like guarantee. So it kind of comes in and out of the marketplace. So there's a lot of debt funds today that all went, there were zero debt funds back in 2012, and now there's a ton of debt funds out in the marketplace.
And some of those debt funds you got to be very careful of, that they'll offer financing in the transaction, but they're loaning the money to own the property down the road. So if you default in the deal because you just can't make it work, or your pro forma that you originally were talking about to them at the beginning of the deal doesn't get fully executed the way you thought it was, and the money doesn't come in and you cannot refinance, the debt fund that promised you that higher leverage is going to come in and take over the deal.
Yeah.
So they're going to wipe you out of all the equity and all the hard work you put into it. So, be very careful. The last thing that we were talking about, these bad boys, we talked about, not standing in the way if Fannie Mae wants to foreclose them on the property. The other thing is that if you do get an insurance claim against the property, your lender is your biggest, in this case, Fannie Mae is your biggest partner in the deal. They want to make sure that they hold the check instead of you holding a check in the operating account. You got to tell them that there's been any material changes to the property. You got to make sure that if you ever store chemicals of any great size or capacity of carcinogen type of chemicals in the property, you got to let them know. You got to make sure your financial statements get over to them once a year. Every 6 months, they probably want to see your operating statement and your rent roll, kind of see how the property's going. They're your biggest partner. Even though you're telling your other partners how the property's doing, you got to tell them contractually how the property's doing. So every 6 months or a year, and how you're doing, personally, how you're doing too. So there's a number of things that non-recourse lenders are going to require you to send to them, and that's usually a good thing. Yeah,
so the key principles on the deal is, you got typically all the managing members need to sign on as a key principal. And then if you don't have enough net worth or liquidity to satisfy the minimums that they require, which is typically about 10% of loan amount for liquidity, and 1x of the loan amount for net worth. That's when, to put these deals together, you tend to bring in maybe some of your investors that invest actual cash in the deal, can also come along and sign on the note as a key principal to kind of help you meet either one of those liquidity or net worth tests. But if you're the managing member, you certainly need to sign as a key principal, because you're the one that they're going to contact when they need something on the property, either they're reporting and they want to kind of hold you responsible. And then if you fall down, then you have the other person that as a key principal, they come and knock on their door and try to either get the information or money out of them if there's a problem in the deal. So, when you're signing on as key principal, you need to expect to have some sort of economic interest in the deal with actual cash invested. The lenders, they just don't like it, the kind of the gun for hire concept where you just get paid a fee, but you don't actually have any risk capital in the deal. That was one of the things we hated when I was a banker, because, I saw deals where the sponsor didn't have any actual money in it, but he signed my note, and then the investors didn't sign the note. And then when there's a problem, you needed to fund the deal. The investors are like, well, hell, I'm not throwing good money after bad. I don't want to do it. Then the sponsor is like, well, I don't have any money in the deal, so I don't want to throw it. So then the problem of the property goes from being the ownership problem to the bank's problem pretty quickly. So that's kind of what they don't want. They want to have people actually have, skin in the game.
Can't have explained it any better than that. Skin in the game.
It's like I do this for a living, huh?
Well, let's talk about a little bit about what you do for a living. What do you and your group over at SPI? Again, SPI stands for what?
Yeah, so our company's Strategic Property Investment. So really what the primary focus in particular for the rest of the year is just to get high quality opportunities, identify them, tie them up, raise the capital, then operate them, and, ultimately return capital through operations a little bit at a time, and then hopefully have a big old pot of gold at the end of the rainbow when we kind of go in and implement our business plan. It's time to exit. So if people want to find more information about us, the easiest way is simply go to our company's website, which is spiadvisory.com. That's SPI like SPY, stands for Strategic Property Investment. So spiadvisory.com. There's a contact us form. Fill that out. I'm always happy to have a 10 or 15 minute conversation with listeners of the podcast. I tend to have probably 2 to 3 a week, which I'm always shocked that there's that many new people that keep reaching out to us. But I always enjoy getting to know people, and we've certainly have many partnerships formed off of this podcast, which is just an amazing thing to me. I never thought that we'd be, approaching basically 1 million downloads in our career, Paul. That we've had this podcast downloaded over 1 million times now. That's just a staggering amount for a couple. There's a whole lot of apartment nerds out there, I guess, that listen to our podcast.
That's right, absolutely. So I'm Paul Peebles. That was Michael Becker. Have a great day.